The Reserve Bank is approaching a crucial juncture. The central bank unleashed a suite of measures over the past year which played a major role in the economy's remarkable recovery. Just last week, data revealed that economic activity was back at pre-pandemic levels in the March quarter. The RBA's measures have supported the flow of cheap credit to households and businesses and helped to keep more people in jobs and more businesses afloat. The central bank has flagged it will decide the fate of two of their core policies at its July meeting, specifically their yield curve control and quantitative easing policies. The RBA will determine whether to extend yield curve control, which is where the RBA buys bonds to keep the 3-year bond yield anchored at around 0.1%. More precisely, the RBA will decide whether to roll the target from the April 2024 bond to the next bond maturity in November 2024. We do not expect the target to be extended. There are a couple of reasons for this. First, the economic rebound has consistently outperformed the expectations of both market economists and the RBA. In August last year, the RBA had forecast the unemployment rate would be sitting at 9% in June 2021. And by April, the unemployment rate had already fallen to 5.5%. This is a huge improvement. Second, if the RBA were to roll the target to November 2024, this would imply the cash rate won't increase until 2025 at the earliest. In our view, this is too far out given the run of strong data. A rate hike is more likely in 2024. Although, if economic data continues to surprise to the upside, we can't rule out an increase in the cash rate as early as 2023. Then there is quantitative easing, which involves the RBA buying a specified quantity of bonds focused on maturities of 5 to 10 years. This is to lower longer-dated bond yields and as a result also lowers lending rates. We expect QE will be extended in the form of an open-ended program with $5 billion a week in bond purchases. This will follow the conclusion of the current round of QE by September. This is the second tranche with $100 billion in purchases. An open-ended program would provide the RBA with flexibility. It could adjust purchases in response to the actions of other major central banks and the flow of economic data. The RBA has emphasised an important factor for its QE program is the actions of other central banks, namely the US Federal Reserve. If the RBA were to begin tapering bond purchases before the Fed, this could put upwards pressure on the Aussie dollar and make our exports less competitive. Importantly, we also now know the RBA will hold a press conference after the July meeting. This is unusual. Previously, the RBA has utilised press conferences to mark a significant change in policy. Judging from history, a simple extension of QE in its current form would not warrant a press conference. So what does this all mean for financial markets and lending rates? The conclusion of yield curve control and the eventual tapering of bond purchases will likely put upwards pressure on bond yields and the Australian dollar, and subsequently upwards pressure on lending rates. The RBA is swimming in uncharted waters. Navigating the exit from unconventional monetary policy will be a tricky exercise with lots of moving parts to consider. Regardless, the withdrawal of policy support is likely to be well telegraphed and very gradual.